If 2024 was about momentum and 2025 was about reality setting in, then 2026 is shaping up to be about discipline. Inventory has rebuilt, buyers have leverage again, and the extreme conditions that drove Calgary's boom are no longer in play. Now, that doesn't mean that a crash is coming, but it does mean the market has fundamentally changed. Today, I am breaking down what to realistically expect from Calgary's real estate market in 2026, using real sales data, real pricing trends, and the broader economic signals that most people completely ignore. Instead of guessing where the market is going, I prefer to work backwards from facts. We know we have a full picture of how 2025 actually played out. And we also have macro data that tells us what pressures are building and which ones are fading. So in this video, we're looking ahead to 2026 with clarity, not hype. Let's break it down. Heading into 2026, Calgary is not entering a boom. It's also not entering a crash. The most likely outcome is a stabilization year. Population growth has slowed compared to the post-pandemic surge, but Alberta remains one of the few provinces still growing. This means demand hasn't disappeared. It has normalized. At the same time, inventory rose sharply in 2025, and that supply doesn't vanish overnight. Buyers now have time, choice, leverage, which fundamentally changes how the market behaves. This combination points towards balance, not acceleration. So, what's pricing expectations for 2026? Broad citywide price growth is unlikely in the upcoming year. After benchmark prices declined through much of 2025, the market now needs time to absorb excess supply. Historically, that leads to prices moving sideways rather than sharply up or down. In particular terms, that means pricing in 2026 will be range bound. Some properties will sell well, others will sit, and pricing accuracy will matter more than timing. Any appreciation that does occur will be selective, not universal. Detached homes in 2026. This will remain the most resilient segment of Calgary's market. Future supply is limited, especially in established neighborhoods, and detached homes are less exposed to investor behavior and rental market shifts. That creates a soft floor under prices. In 2026, detached homes are likely to stabilize first. Prices may drift modestly up or down depending on location and condition, but sharp declines are unlikely without an economic shock. This is not a growth market for detached homes. It's a quality and pricing discipline market. Semi-detached homes sit in a similar position, but with slightly more sensitivity to inventory. They benefit from affordability relative to detached homes, which supports end user demand. However, rising supply caps upside potential. In 2026, semi-detached homes are likely to trade in a tight range. Well-priced homes in a good location will sell. Overpriced listings will struggle. Stability, not appreciation, is the most realistic expectation. Row homes enter 2026 with more pressure than detached and semi-detached properties. This segment was heavily affected in 2025 by new build competition, investor pullback, and slowing first-time homebuyer demand. Those factors do not resolve quickly. Early 2026 is likely to remain buyer-friendly, with negotiations, incentives, and longer selling timelines still common. Any recovery in this segment is likely gradual and dependent on inventory being absorbed, not on demand suddenly surging. Condos remain the most challenged segment heading into 2026. Rental supply has expanded rapidly. Vacancy rates are rising, and rents have softened. That removes urgency from both investors and first-time homebuyers. As a result, condo prices are likely to remain under pressure early in 2026 before stabilizing later in the year. This becomes a value-driven, not a growth market. For end users, opportunity exists. For investors, strategy matters far more than appreciation. One of the biggest shifts heading into 2026 is where pressure shows up first. Rental markets are adjusting faster than resale markets. A reduction in non-permanent residents impact rentals immediately, while ownership demand tied to permanent residents adjust more slowly. That means rental softness does not automatically translate into a housing crash. Instead, it supports stabilization in resale pricing while keeping investor demand muted. This dynamic favors end users over speculators. Sales activity in 2026 is unlikely to surge. More realistically, volume will track closer to long-term averages rather than boom year highs. Buyers are active but cautious. Sellers are active but increasingly price sensitive. This is a market where strategy matters more than speed. Homes priced correctly and prepared to sell will sell. Homes chasing yesterday's prices are going to sit. There are a few factors that could shift the market either direction. A meaningful drop in interest rates could unlock pent-up demand faster than expected. Stronger than anticipated employment growth could also tighten conditions. On the other hand, further inventory increases or broad economic uncertainty could extend buyer-friendly conditions longer. As of now, none of these factors dominate, which reinforces a stable and balanced outlook. So here's the realistic takeaways for 2026. No boom, no crash, more balance. Detached and semi-detached homes stabilize first. Row homes and condos lag longer. Buyers remain selective. Sellers must be disciplined. This is a market where good decisions win, not emotional ones. If you're planning to buy or sell or invest in Calgary in 2026, the strategy you use will matter more than timing the market. If you want a property type or neighborhood specific outlook based on real data, reach out anytime. I'm happy to walk you through it. As always, click the link in the bio. Thank you for watching.